Welcome back to another episode of FPOG, Financial Planning for Oil and Gas Professionals. This week on the podcast, we're going to talk about the convoluted math that goes into thinking about a second home, thinking about it from an investment perspective, an enjoyment perspective, return on time perspective, all the different ways you can measure, does a second home make sense? But Justin, before we get into that, it's early September, which means college football is upon us. And it also means that Arkansas football is undefeated. I don't know how long that's going to last with us playing at Oklahoma State this weekend. But, we had a great first game, 170-0, which for Arkansas fans, we've lost a lot of games we weren't supposed to lose. So, there are no gimme games as an Arkansas Razorback. So I'm feeling optimistic, but I have tempered expectations in light of the gauntlet of a schedule that we have coming up. How are you feeling going into college football season?
I watched that Arkansas game. I was pretty shocked by how athletic the quarterback is. So I think this weekend's going to show a lot. It'll be interesting to see if they can compete and pull off an upset in Stillwater. K-State, kind of had an easy, I think we played UT Martin. We did play UT Martin. I know, I watched the game. But, a pod. So we got through it, won big. K-State is kind of the preseason favorite to win the Big 12, but I think it's different from our previous Big 12 title years. I don't necessarily feel ultra confident. And so we're at Tulane, and then we have Arizona over the next 2 weeks. And so I'm hoping that we can kind of show the promise that caused us to be preseason favorites. Jared, I will also mention, we've got a lot of Aggie listeners. I think I've maybe said this before on the podcast. I grew up with just a massive college football addict. So my family, we had season tickets to Kansas State games. We went to, I'd say, 2 away games every year on average. And so I have been to 11 of the Big 12 stadiums. Now, there's different teams going in and out of the Big 12, as we all know, but I've been to 11 of them. And the one that we didn't make it to, unfortunately, kind of the most unfortunate one, was Texas A&M. And they're, known to have such an unbelievable environment. So I got to go to my very first A&M game on Saturday. They played Notre Dame. And, Jared, it is absolutely a top college football environment. It's unbelievable. Over 107,000 people there. I think they have the best intro of anyone in college football I've seen. It is a magical environment. It is unbelievable. So hats off to A&M. Unfortunately, they couldn't pull it out, but brand new coach. And, I think they'll get the ship righted eventually.
And it's tough to schedule that premiere of an opponent week 1. I think with the expanded college football playoff, I think it's good for the sport because people feel some liberty to have some strength of schedule, knowing they can lose some games. So it'll be fun to see how things expand. I guess my final question for you before we start talking second homes, what probability would you assign to Kansas State going to a college football playoff in the next 5 years?
Jared, it's so fun that the playoff has expanded because I'm going to say my gut says 70 to 80%. We're the Big 12 favorites this year. We are the winningest program in Big 12 history. All you have to do to get in the playoff is you got to win your conference. And then at some point in the next 5 years, I think the Big 12, I don't think we're ever getting 3 teams in a 12-team playoff. At some point, maybe 3 of the 5 years, I think we could sneak 2 teams in. So do I think we can win the Big 12 or sneak in barely as an at-large in the next 5 years? I really think we can. Growing up and really even as an adult, it's been miserable to be a K-State fan because we don't get the benefit of being, an Alabama, a USC, a Notre Dame. If we lose, we are totally out of the conversation. So we had to go 12-0, 13-0 to ever have a chance to play for a national title. And so the idea that we could have a spot in the playoff, even if we're 9-3, but we win the Big 12, that's exciting. I think it's a good move. And I hope that the playoff expands further. How would you grade Arkansas's chances over the next 5 years?
I'd say 30%. The interesting thing about the SEC, I think every year we're going to get at least 3 teams.
And I think 5 some years.
I think 5. I think depending on who you ask, 5 could be pretty easy. In the next 5 years, I don't think we're going to win our conference. But I do think we could put together a 9-3 season. We've done it, in my lifetime. And so I think the right mix of people in the right games in the right, situation could kind of have us sneaking in. But, the SEC is also just so dang strong that even 5 spots, there are a lot of very good teams in the SEC. If you think about how deep of a conference it is and how big of a conference it is, like even if you have 5 every year, that's no small order. So I'd say 30%, but that's also just the heartbreak hog in me. Hopefully it's a little higher.
Yes, but I love it. I mean, you could be 5-3 heading into November. And if you win out in November, there will be teams that make the playoff in that scenario. And that's fun. I mean, if you were 5-3 at the end of October for the past, 100 years, your season was over. You didn't have a meaningful game in all of November, and the season just started 7 weeks prior. And so it's a needed change. I hope it continues. I hope the playoff goes to 24. So it'll be fun.
All right, Justin, let's talk about second homes. I would love for you to kind of frame this, right? Because this wasn't necessarily a listener question, but this was a water cooler conversation. So I would love to kind of for you just to frame this up. Why are we talking about this and what do we kind of hope to accomplish and how are we going to break this down?
Yeah. So, I thought about this. I was playing golf with a couple of guys last week, and one of them made the comment that if there were a second or third home purchase at some point, that it needed to be a great investment. And so the way that kind of plays itself out in this instance is, hey, instead of going to the most popular destination that is already, 10x in price, maybe that means going to an up and coming destination. You could play that out in a few different ways, but it really just means, hey, if I'm going to buy a second or third home, I'm not going to Vail. The whole world's already gone there. The prices have already just exploded. So instead of going to Vail, let's find the next Vail. So let's pretend that it's 1982, it's 1972. What is going to be the next Aspen or Vail, or what's going to be the next 30A, whatever the case may be. I found that thought process interesting, and I can't decide whether I agree with it or disagree with it. Jared, on the investment front, I mean, I totally agree. And I think we've maybe mentioned this on the podcast before, that if you look on Zillow in Colorado and you look at like the $70 million homes, I mean, for the most part, it's giant plots of land that people developed over 20 years. And so it's, it's a 40-acre plot in Aspen. And you were fortunate enough to buy that 60 years ago. You slowly add on to it, and now it's an absolute compound, and you get that unbelievable price for it because there's a premium on land. So then from an investment perspective, hey, it totally makes sense. Maybe it's Pagosa Springs, maybe it's somewhere near Durango. But if you can buy an enormous piece of property, especially that has a lot of land, you've got to think that over the next 30 years that could just explode in value. But then it got me thinking, I'm 36 now. I'm only going to be 36 to 70 years old once. And so if I'm going to buy a second or third home, I don't want it to be a place that's just an investment. I've got to be really excited about being in this place a lot for the next 25 years. And then it kind of leads into, I think we're calling this the convoluted math of a second home. And hey, everything about a vacation home is a little bit convoluted, and there's a lot of moving parts to that. So where should we go from here?
Yeah, I think you broke it down good, right? Like there's 2 reasons you might decide on a second home. And I would argue the more you think it does both, the more likely it is a spork and doesn't really do a good job at either. And if you say, hey, this is going to be a good investment and it's going to be a good financial investment and a good investment in my life satisfaction, like it's probably not going to be great at either of those, right? Because it's kind of like a spork. It tries to be a bunch of things, isn't really good at anything. Or like cash value life insurance, same thing. Is it insurance or is it investment? Oh, it's both. And it usually does a bad job at both. Let's take each of those individually, because I would argue don't try to do both. And we could talk about it, but like, is this actually an investment? And there's a different set of questions we would ask if that's the case. Or is this a lifestyle decision? So Justin, I think a good place to start is, let's say it's a lifestyle decision. What questions should someone be thinking about in terms of, hey, does this make sense for me? Because even if you can afford it, it's not just necessarily, oh, I can afford it, I like it, I'm going to do it. What should people be thinking about if they have the financial means to do it?
I think that level zero of this conversation is trying to figure out what is the true cost of ownership, and trying to figure out, hey, what happens if insurance companies continue to pull out of the state of Florida and you're wanting to buy a beach house in Florida? Is it possible that the cost to insure your home is just 4x what you ever imagined it could be? And there's a lot of people that own Florida properties today that are thinking, yes, that's precisely what's happened. Property taxes. What is the state that I'm buying in? What direction are they going in property tax? Are they trying to tax state residents via income tax, sales tax, or is it more property tax? And so there's an entire conversation around how do you know the true cost of ownership and how can you ensure that you are in a secure position to add a vacation property? But then past that, Jared, if you're asking besides that point, where do we go? I mean, I think a huge question is just utilization. What percentage of your time are you going to spend creating meaningful memories there? Where would you go from there?
No, I think that's important, right? Like, how much time will you spend in this place realistically, right? And just the ROI in terms of investment, like if you think of a total cost of ownership and give yourself some margin there, right? Especially if you don't want to manage it and have people managing it. Like, okay, how much time do I plan to spend there? Okay, if I plan to spend 30 nights a year there and it's going to cost me $100,000 a year, okay, it's about $3,000 a night. Just to give you just rough back of the envelope of hey, what's my utilization ratio? And okay, like if I'm going to spend 30 nights, okay, 10% of my time there, is it going to take 10% of my mind share, right? Or 10% of my discretionary budget? Right. So just beginning to do that utilization ratio, I think, is a good step. But I think 2.0 is taking inventory of your ideal travel, right? Because what happens when you own a rental property is a second home is you've made a concentrated decision about your future travel. You have a moral and a financial obligation to now use that property, right? So if let's say you have 40 nights a year that you're going to vacation and you've done the math, and for this to make sense, let's say 20 nights a year, you need to stay at this place for it to not, it's not going to make money, but just to be reasonably priced vacation with a little more flexibility and customization. That's 50% of your travel budget in terms of days, if you will. What does your travel bucket list look like? Do you want to go to Europe? Do you want to go to all 7 continents? Do you want to live abroad? Do you want to, or are you really excited with having one place that you spend a lot of time in? And you would say, hey, I want to spend my winter in Texas and I want to spend summer in Colorado, right? And it's like, that's it. I don't need anything else. No international travel for me. Great. But, when you decide to get a second home, you're really concentrating your travel portfolio. So just take inventory and say, hey, is this how I want my travel life to look? Because a lot of your travel is now spoken for if you don't want to burn money on this second home. So I would say, hey, what concentrated travel ratio are you comfortable with, right? Like if you're a retiree and you can travel 100% of the time, then, it might not be a big deal that you have a space you would like to spend 30 nights a year at to kind of make the math work out.
Jared, did I send you the tweet from last week or 2 weeks ago? I got worked up about it. It was the guy who is moving his family from a Dallas suburb to Raleigh, North Carolina. And they're building a very nice home in Raleigh, North Carolina. Did I send you this tweet?
You did not, but I saw it. I know the tweet you're talking about. We'll link to it in the show notes.
Okay, nice. I got so worked up about this. So he made a huge thread about how, hey, we're moving to Raleigh because homes in DFW have no character and there are not enough trees in DFW. And the kind of short story is, well, they live in a suburb really far away and they're moving to Raleigh in what looks to be probably a $4 or $5 million home. So a very nice home. And for that budget, you can absolutely live in one of the 20 neighborhoods in DFW that have incredible trees, incredible architecture. But I mentioned that, Jared, to say, I do think living in Houston or DFW full-time and then having a second place in California, Colorado, Montana, somewhere that's colder, I think that is a top 5 living situation in all of America. Jared, what do you think about that take?
It's a very, very pro-Texas take. Yeah, it's not my ideal mix, but I do think it's a good mix, right? I think Texas is the greatest state in America to make money in. And so I'm actually pro Texas's climate. Summers are brutal, but they're not that pleasant in most of America.
Yeah.
So it's not like I'm going to go on 100-mile bike rides in Northwest Arkansas because it's only 95 instead of 105. And the falls are so manageable. And right, you have some of the best airports, the most robust airports in the world, right, in terms of accessibility to other places. So yeah, I think you're onto something there with the Texas hub with no state income tax and great quality of life and ability to build a meaningful life, and also direct flights to better weather when you want to escape the summer inevitably.
Great point. Which, I mean, does kind of bring up one of the points we want to cover here, and that is accessibility. And so when you're buying a second property, just how accessible is it and how easy is it to get there?
Yeah, right. And like I would argue, again, the people you were having this conversation with were working professionals. If you're retired, like your accessibility ratio, like if it takes 10 hours of travel time or 5, it probably doesn't make a difference to you, right? But if you're a young professional with a family of 5 more hours in travel time could make or break your ability to do the trip, right? Or if you're flying to somewhere with 4 flights a day or 1 flight a day, and like the earliest flight's at 8 versus the earliest flight's at noon, and conversely, the earliest flight coming back is at 5 p.m. versus 8 p.m., that could like make or break the math of whether or not you could pull off a weekend trip. Just a great like granular example of this, right? Like if you buy in Snowmass, which is, we'll talk about this later in kind of the investment piece, but like you can fly direct from DFW to Aspen, 2.5-hour flight, and then you're 20 minutes from the airport, right? And there's probably, I don't know, let's say 5 flights a day. Conversely, if you take the value investor approach that you were talking about and say, hey, I want to buy in a cheaper geography, a little more rural, Snowmass is a bubble, right? Okay, awesome. You buy in a place like Rifle, Colorado. So you fly into Grand Junction, which probably has maybe 1 or 2 flights a day. And then you're probably hour and 20, hour and 30 minutes from, the Grand Junction airport to where you want to live, right? So your travel time could easily be double if the flight times don't work out, right? And again, if you're retired and you have the discretionary time to do it, not a big deal. But like Justin, if you said, hey, I have 1 day off and I'm trying to make this trip happen, I might be speaking for, I'd be curious what you think, but that could make or break you deciding whether or not it's worth pulling off that quick trip if you can only get 48 hours there.
Yeah, I have no idea how to think about a property in another state. We have 3 kids. All 3 of our kids are in elementary school. And so we're in a little bit of chaos. We are probably going to get a second place at some point. And I mean, my word, anyone where I'm from listening to this in Kansas is going to think this is just the craziest idea ever. But I mean, our second place is almost certainly going to be in North Houston. And so, and that's all comes down to accessibility. I am spending an enormous amount of time in North Texas and in Houston. And then we have clients spread out in, 10 to 15 states now, at 10-ish, something like that. And so something that makes it more conducive, more enjoyable for me to spend a lot of time in the geographies that we need to be in, it makes sense for us. And so it's not just accessibility of a second home, it lines up with our work and kind of what we're doing in a primary sense. But Jared, it's really tough to think about in my stage of life now. I don't even feel like the discussion will even be there for an out-of-state property until kids are, much closer to college.
Yeah. And I mean, like a great example of this is like my family's farm in Honduras. Like it's unbelievably beautiful, right? My family has a 300-acre tree farm off the coast of Honduras. Rainforest, views of the beach. I could walk to the beach. I could hike in the rainforest, waterfalls, all on the property. It's breathtaking. It's unbelievable. I don't have a direct flight there. It's going to be $1,000 per person to go. And it's 2 flights, one to Houston or DFW or Atlanta, into the city. And then from whatever capital city I land in Honduras, the capital city or the other airport, it's a 5-hour drive by 2-lane road, right? And so like the cost for me to get there is like substantial, and it's free and it's cheap and it's beautiful and it's unbelievable. And like my wife and I lived there for a while. We have a lot of really fond memories there, but the cost of getting there is so high. It's pretty much, 12 hours each way if you have short layovers and you're kind of cutting it close. And so like the cost of going is just so high that, and I don't really have the time for that. So like, even if I want to go and it's the most economic way for me to go, and it's my family's property, it's not even mine. Like I have this free, beautiful place to go and I don't take advantage of it because the accessibility ratio is way out of whack for my stage of life.
Jared, I feel like there could be an entire TV show following the Machen family and seeing how Ellis as a 1-year-old does on a 14-hour commute trip.
Yeah, I definitely, the genre would probably be horror. So yeah, but so again, right? Like just again, thinking through the inventory of like, in your case, Justin, like thinking about being in North Houston, you're a 3-hour drive, like 3 hours from door to door, right? So you could go for a night and that's a worthwhile trip, right? Yes. Like Honduras, conversely, I need to go for at least 6 days for it to even begin to make sense for the 24 hours of travel and headache that I'm going to endure. So like, you're going to use that exponentially more than I am because it's so much easier to get to. So just, I mean, I think it's important for listeners to say, take honest inventory of, okay, how accessible is this place to me? And what accessibility trade-offs am I making? Because even Colorado, if you say, hey, I live in Boulder and I can fly JSX to Boulder and I'm 5 minutes from my house, is very different than saying, hey, I'm just on a plot of land in the Front Range and I have to drive, 2 hours from the nearest airport. Like that makes it seemingly doesn't make a big difference, but I think it really does in terms of utilization.
I mean, Jared, I think the other thing about lifestyle, so if you're buying a vacation property as a lifestyle decision, you need to emphatically love the place. I think about retired founder. So we had him on the podcast several months ago. After his second kind of private equity sale, I think that got him to like 60 million. So it was before the third sale, but he now had enough money to where he could, buy any home he ever wanted. And it's interesting that he immediately went and bought 3 homes and he hated it. And it was, pretty funny to hear him talk through that, hey, the right number of homes to own is 2. That is the perfect number. You don't want more than 2. 2 is absolutely perfect. And you've got to love the place that you own. The amount of headaches that he went through is just, hey, the headaches better be worth it. When you show up and there's something, there's a hole in the drywall, there's something wrong with the fan, the oven's not working, this or that's going wrong. You better love the place enough that you don't care that, hey, your first 8 hours at your second home is spent figuring out how to solve problems.
Yeah. And that gets to the final point of like thinking about second home as a place for, investing in family memories and meaningful experience. The mind share ratio. So if you think about it, like how much time can you or will you need to spend thinking about this property to ensure everything's taken care of? Right? Like if you buy a big plot of land that you need to subdevelop and you're like managing a bunch of that and you're spending 20% of your time and you only go there 5% of the year, that equation's kind of out of whack. This gets to an important question of, right? Like in Retired Founder's case, he had all the financial means to delegate it, but even like, hey, I've never lived in this city. How do the toilet's messed up? Who do I even call? Right. Yeah. And so like thinking about, okay, like how much time do I have and am I comfortable with spending and thinking about this property, right? That's another thing you should kind of take inventory of and be aware of.
Absolutely.
Those are, I think, some good things to think about from the, hey, second home as a lifestyle investment, right? Because it's not just incinerating money, it's investing just in a non-financial way. So that's thinking about it from that frame. What would you say to the person that's like, hey, this second home needs to be an investment? What do you think that person should be thinking about?
If we get really specific, Jared, I think your balance sheet can look very different based on, is this a lifestyle decision or is this an investment decision? If it's purely a lifestyle decision, we just did a podcast on the book Die with Zero. And hey, I mean, if your biggest goal and if you would absolutely love, if you would just make so many memories, if you bought a $5 million second home somewhere, well, you could probably do that as early as, when your net worth hits 10 million. Most financial planners, Jared, would hear, hey, buying a $5 million second home with a $10 million net worth is the stupidest decision in the world. And maybe it is, but that camp of Die with Zero is kind of a compelling case of, hey, like if you really want to do it, you can make it happen. Now, let's talk, just like you said, about the total opposite framework. So on the opposite end of the spectrum, you're trying to figure out, hey, how can a second or third home be an excellent investment? Then you start to think of it, what is this asset that I'm buying? And what is the place that it holds in my personal family balance sheet? And Jared, that really gets to, okay, this is an alternative investment. It's a concentrated alternative investment. So there's no diversification here. Real estate in general could go way up. And a home in, I don't know, Santa Fe, New Mexico may or may not go up. Maybe it goes up way more than the national average. Maybe it goes way more than the New Mexico state average. Or it could go not nearly up as high as national or state averages. And so it is a concentrated alternative investment. And so if you are running your balance sheet like a portfolio manager, well, then you probably want to keep it to 5% of your total net worth, or maybe even total investable assets, which means that, if you want to buy a $500,000 second home, well, let's try to get the balance sheet to 10 million before you do that. Jared, if you want to buy a $3.5 million second home, let's try to get the balance sheet to, what is that, 70 million before you do that. And so, those are, how wide is that spread that I just described? And that's how different it is to view it from, is this a lifestyle choice, to, am I a portfolio manager making allocation decisions? If it's all about investment, well, then the second home is going to be a tiny percentage of your net worth. And I don't think it has to be that. But if that's how you view it, if it's purely investment, it probably should be.
Yeah. And I mean, a couple caveats, right? It's a leveraged investment, right? So if you can put 5% down on a $750,000 home and the house appreciates by 5%, gross return is essentially 100%, right? Because you invested $37,500 and your appreciation was $37,500. I realize it's a very oversimplistic explanation because there's a lot of financing costs, carrying costs. But again, returns are magnified, right? So not only is it a concentrated bet, it's a concentrated and leveraged bet. So your range of outcomes are way wider on the upside and downside. And so, right, you just need to have a balance sheet that's comfortable handling that, right? And the other thing is like your liquidity ratio, right? Like even if it meets your diversification goals, okay, like how liquid are you, right? Like if you have $30 million and you're spending $500,000 a year, let's say, but of that 30 million, 20 is in a privately held company, 5 is in a bunch of private equity deals, 4 is in real estate, and 1 is in a liquid portfolio you can borrow against, your liquidity is all out of whack, right?
Totally out of whack.
And so you have the balance sheet philosophically, but you don't have this balance sheet structured in the way that it can actually produce the income you need when you need it to cover the inevitable expenses that come with these leveraged and liquid assets.
Jared, let's make a quick point there. So it is crazy how different this entire conversation is depending on, do you own your company or are you a very highly paid W-2 employee? So Jared, you just mentioned someone with a $30 million net worth, but 20 of it's in their privately held business. And most of their balance sheet is not liquid. You can't set up margin loans against it. So Jared, in that case, if they want to fund a really expensive second home, their income from their privately held business better be in the 7 figures. I mean, their income better be massive. It better totally pay for their normal expenses, and it better easily cash flow the entire second home and everything that could potentially, become incurable with that. Now, on the flip side, if you're retiring from a major and you were one of the top 100, 200 people in the company and you have $30 million, well, that's just completely different. Your entire balance sheet is liquid. And so you can go about this decision in a totally different manner. And you know what? I kind of think that even lines up with between owning your own company and being W-2. I think that's going to be a massive decider in, are you trying to look at second and third homes purely as an investment, or is it all about lifestyle? And it's just something you want to do and you're going to cash flow it.
That's exactly right. I think like understanding your personal balance sheet and where the slots in is rule number 1. But like, I think we'd be remiss if we didn't say, hey, your total cost of ownership Like this math still holds true. Your utilization of this place will help offset it, but like understanding your total cost of ownership makes a huge difference, right? Also, I don't know how you would feel about this, Justin. I think if you were in the investment camp, there has to be a rental ratio, right? Like appreciation enough won't be enough to make it a worthwhile investment because the carrying costs of these things are so high. Maybe if you pick the canary in the coal mine of like the next big Colorado town to be developed and you own 20% of the buildable land in that area, but the capital that would require today to do and the annual property taxes of that and the timeline for realization of that, even in that scenario, even if appreciation is really remarkable, you're just paying property taxes. It's just a burn of incremental cash for an extended period of time. So like, I don't know, would you say that somebody thinking about an investment, a second home as an investment, has to think about renting it? Because I would say probably, yeah, because you're just digging yourself a huge, not an insurmountable hole, but probably from an investment perspective, unless appreciation is astronomically above historical averages.
I think one of three things needs to be true if it's an investment. One is what you just mentioned. It has to produce pretty incredible rental numbers. There's probably 20 different ways to be a real estate investor. There's a lot of different ways you can kind of dice it up. So rental income is obviously one of the ones that people think about most often. And yeah, that needs to be pretty high. Or number two, if you hate the idea of renting your home, it probably needs to be what we said earlier. It needs to be a really small fraction of your overall balance sheet, right? And you need to have investments in a lot of different places, doing a lot of different things. Number three, so you're not focused on rental income. Instead, you do one of the other ways that people can make money in real estate. You are a developer. And maybe it means you own hundreds of acres, or maybe it's, still a bunch of land. And over the next 10 years, it's going to look like a very different property than what you originally bought. And, I think I would tag on to that hopefully you're able to secure some sort of exemption to help on the property tax front. And so I think you either need to take a rental strategy or just, hey, I'm going to buy this $2 million house, but it's okay because I have $20 million. Or you need to, I'm going to buy 60 acres. And 10 years from now, it's going to be an absolute compound. And I'm going to trust that 10, 20 years from now, there's just not going to be a whole lot of land like that available. And it's going to appreciate just way more than other properties in the area. So I think it's got to be one of those three things, Jared.
And also, appreciate way more than other properties in the area and way more than a publicly traded equity portfolio that's liquid, because you're locking your money up for an extended period of time. And there's a carrying cost, right? If you think about equities and fixed income, they produce dividends, coupon payments, right? It pays you on an annual basis. Owning even a property with the hopes of appreciation, there is a carrying cost to that, and a lack of liquidity and a liability that you have on property that you don't necessarily have being a passive investor in an equity portfolio. So like all of those things, like market level appreciation isn't going to cut it.
This is such a fascinating topic. If you could take a vacation home and turn it into an expense ratio, I'm pretty sure you're going to see expense ratios of like 6, 7, 10, 12%, which is hilarious. The entire world of investing over the past 20 years, there's been this massive movement to low cost, lower fee. We love that. I mean, it's been incredible. The experience for the everyday investor today is just light years better than it was 10, 20, 40 years ago. And a lot of that is tied around better access to the markets through lower cost funds. But then, Jared, it's interesting. Private investments don't face nearly the scrutiny that public investments do when it comes to expenses. And then second homes are on a whole different level. You thought 2 and 20 was bad. Wait until you own a vacation home and potentially 8% of that property is functionally an expense ratio in maintenance and upkeep.
Or even if you delegate it, 40% of the income is paid to a management company.
Yes.
Right. There's no passive low cost way to invest in this. And it's a really, really concentrated bet. But I think that's where people get into trouble. They say, hey, I use it some, so I'm cool with the expense ratio because like I get some life satisfaction out of that, which is great. But I would just like decide what is your primary motivation? And maybe you can have both as motivations, but I would argue the more you want to succeed at both, the lower the odds that you get either. So I would really just prioritize and think about, hey, how do you think about this? Justin, we also need to acknowledge like investment, like if you have the investment lens, acknowledge where you are in the cycle, right? Like
Yep.
home prices are at an all-time high. The easy money has been made. You're in a post-COVID world. Houses are way more expensive. The cost of ownership is exponentially higher than it was because houses are more expensive and interest rates are higher.
And property taxes are higher.
And property taxes are higher. And if you plan to rent this property out, you are competing against a pool of people that probably paid substantially less per square foot than you did and have a substantially lower interest rate than you do. So that doesn't mean you can't be successful. That does mean the wind is, you got a headwind.
Yeah, that's right. That's right. You said it perfectly. It's going to be much harder for it to be a good investment today. And, I think at the end of the day, there probably needs to be a little bit of both of this. Even if, I mentioned my friend was really viewing this decision as, hey, it needs to be a great investment. I think even if that's your mindset, there needs to be a massive lifestyle reason to do it. You either got to be okay renting it out, and there's a ton of headwinds to doing that. You need to be a little bit of a developer and kind of develop the property into something totally different than what it is the day you buy it, or it just needs to be a small fraction of your balance sheet. And that can work as an investment.
And Justin, I just want to chat, like one of the things you said that we need to just acknowledge, one of the things that I heard was, hey, I want to go where it's not too expensive yet. And like, I want to find the next bargain. I don't necessarily know if that's the way it works with second homes, right? Like here's a great little anecdote, right? I was curious because Colorado is a place where a lot of our clients end up or have second homes. So
I haven't looked at this yet. I know you sent this prior. I'm excited to hear whatever you're about to say.
So it looked at the top fastest growing home prices, like by city in Colorado. Number 50 was Drake, Colorado, which is, I think it's east of Estes Park, right? So,
News to me.
Smaller city. Over a 5-year period, the appreciation was 42%, $152,000, right? So you could get in the 300s. And like 5 years ago, you might say, man, Drake, it's a good value. That's an excellent return over a 5-year period.
Yeah.
Right?
Really good.
Way over historical averages. Conversely, if you looked at the number one spot, which is Snowmass Village.
Oh, wow.
Right? Just outside of Aspen. And you said, hey,
5 years.
Yeah, Snowmass is a bubble. The starting home price is $1 million in 2018. You say, no way, that's a bubble. I'm going to go to the value. I'm going to go to the value in Drake. Over the same period, again, Drake had appreciation of 47%. Snowmass had appreciation of 101%. So the 5-year price change, it appreciated by $1 million, right? So the whole idea of buying the cheaper spot didn't necessarily work in this scenario. And we'll link to this, but a lot of the highest appreciating geographies in Colorado over the last 5 years are also some of the most expensive. So the idea of, hey, I'm just going to buy what's cheap. You had higher percentage appreciation in some of the most expensive geographies. So like, the whole value investor didn't really work because the most expensive places just got even more expensive. So I would caution you if you think, hey, I'm going to buy cheap because it's going to be the best investment and it's a good bargain.
Man, that is fascinating. So real estate can be more of a momentum investment rather than value. I mean, Jared, 5 years ago, Snowmass Village is effectively already just what an unbelievable run up from Snowmass Village from, 1980 to 2019. Pretty unbelievable that happened for a 40-year period. And then it's still trounced everything over the last 5 years.
Yeah. The price in Snowmass was 3X, wow. Right? 3X of number 50 of Drake, right? It's 3 times more expensive. The logical person would have thought, man, this has got to rein itself in at some point. No, gap just widened.
That kind of reiterates, I feel like we say this every, 2 or 3 episodes. To be a great investor, you have to be humble. You have to be humble. And you have to acknowledge that there is a massive unknowability about every allocation decision that you make. Jared, what episode was it that we kind of talked about that idea that like the way most people view investments is like, hey, I talked to this advisor and this advisor is going to do this for me. And they're going to do all of these interesting things and they're going to beat the market. And they've got all these sexy investments and it's going to be better than what Vanguard can do for me. And that when you really break that idea down, if that's how you view an advisor and an advisory firm, you're making a decision that is so ridiculous. It's, hey, I found someone in Cypress, Texas, who knows more about the market than everybody else. Like, what a stupid thought. Like, what an outrageous thought that is. There's no one in Fort Worth or Houston or Dallas or New York City, for that matter, that has some secret sauce that they know where things are going. And so it just reiterates that there's a total unknowability in what you do as an investor. And we don't actually know whether it's going to be a random town that no one's ever heard of, or maybe Aspen just continues to beat everybody. I don't think Aspen's going to continue to beat everybody. Like, surely at some point, value investing has to return, right? So I'm not betting on Aspen being the winning horse for the next 10 years or so. But hey, I'm going to be humble enough to say no one knows. It absolutely could.
Yeah. And I think that's right. Like no one knows. So to think that you do know or that you're certain how it's going to pan out, I would just approach it with humility, right? I think I would argue, hey, you have a massive headwind if you're going to buy a second home as an investment. Not insurmountable, but just acknowledge the reality of that. You're probably better off making it a lifestyle decision. But then again, the second home is, even without expecting financial returns, is a big commitment of mind share and energy. So just identify, hey, is that in line with your ideal life, both today and in the future?
Man, that's a good thought. Maybe we'll do more episodes on, I think I mentioned we're probably going to get a second property in Texas here in the next couple of years. Maybe we'll kind of deep dive into that. But Jared, it's interesting to think, and maybe this is just because I'm a CFP, so I feel like we're kind of trained to think through worst case scenario in everything, right? I mean, on the front end of this, I'm kind of expecting it to be a terrible investment, right?
Terrible financial investment, Justin. If Die With Zero taught us anything, you can invest in, memory dividends. So I think the memory dividends are going to be exceedingly great.
Memory dividends are huge, and hey, the business that we own and operate here means that I spend a lot of time in North Texas and Houston. So if there's an avenue that it's not me spending time, but it's me with Lauren and the kids, it's our family spending time, then sign me up. Let's do it.
Money well spent. Well, awesome, Justin. I think that's a good place to wrap it up. We'd love to hear from our listeners, or even just, non-listeners or people with questions about financial topics. We love riffing on it and just love hearing feedback on the format as we still tweak it and just better learn what people get excited about learning more about. You can always reach us, podcast@brownleewealthmanagement.com. Thanks. See you next time.